All right. So now let's look into the historical record. Um, and this, as I said before in the previous video, this is a very extensive research, um, spanning over 85 years of time series data. Um, so what they looked into was basically world and U.S. risky stock and bond returns, right? Portfolio returns, basically. Um, so they picked world largest stocks, uh, 24 from 24 developed countries. So that's about 6,000 stocks since 1970s. I mean, prior to 1970s, the number of um, developed countries was also smaller, like 18 countries, or and the pool of the countries was smaller, and the pool of the stocks was smaller as well. Um, Now, large for U.S. stocks, the large stocks were Standard and Poor's 5,000, 500. I'm sorry, 500 largest cap, largest capitalization, right? By capitalization. Small stocks, smallest 20% on New York Stock Exchange. S&P 500 is already 500 large, companies representing like each sector or each industry sector of the economy or each industry. So small stocks are 20%, smallest 20% on New York Stock Exchange, Nasdaq, and American Stock Exchange. So currently, these are about 1,000 stocks. World bonds, same as countries as world's largest stocks. Same countries, right? From same countries. Now, you may wonder where they get, how do they pick? I mean, how do they pick world's largest stocks? Um, well, the data pool for, the selection criteria for the world global stocks or world, largest stocks is MSCI. Bloomberg MSCI, data, right? MSCI is, like Morgan Stanley, more stands for Morgan Stanley Composite Index, or I forgot the exact, it always just goes by the acronym, but the full name is, what was that? The full name, uh, I think the full stands for a Morgan Stanley Composite Index or something like that. You can also, Google up or Wikipedia Yeah, it's Morgan Stanley Capital International. Anyway, that is the database, right? They uh, uh, you know, drew the data from, or data pool on. So anyway, so what? And this is table 5.3 or 5 point, yeah, and this is very extensive. I could only put it sideways, horizontally, because you can't um, you can't put it in portrait. Um, this is so weird, but even if it is sideways, you can just turn your head slightly, to the side and look at it horizontally, and you can tell, first, the left. First, no, they are broken down into uh, types of returns, risk, uh, and the sub periods. First, is total return, which is basically measured by geometric average, and total returns are broken down into 4 sub periods, right? The overall 3 sub periods, and the overall entire period, 1926 through 2010, and 1920. So that's the entire period. And 1926 through 1955, and 1956 through 1985, and 1986 through 2010. It's like almost like uh, like 30 years. It's not exactly 30 years in the last sub period, but previously. And then total return is basically nominal return. So they also took real return, and then excess return, right? Excess return is basically risk premium, right? And then they also did excess return in calculated excess returns, an arithmetic average, and took the standard deviation, calculated standard deviation, and minimum return, maximum return, and also deviation from the normal distribution. Right? Remember, the actual using likewise normal distribution, and they calculated kurtosis and skew, right? To check if these results were deviating from normal distribution or not. And then performance statistics, man, it's hard to see. And most of all, Sharpe ratio. Look at the Sharpe ratio. Sharpe ratio, value at risk, and then the difference of actual value at risk from value at risk of a normal distribution with the same mean and the standard deviation. Of course, from like that's what's called likewise normal distribution, right? With the same mean mean average. So in each of these areas and categories. First, they found the equity total world portfolio, right? Equity return and based on US dollar price, right? And then bond return, everything is uh, translated into US dollars, right? The prices were, um, of course, world portfolio would consist of assets being traded in so many different currencies, right? They had to be in uniform, translated into uniform currency so that it can be compared. And then U.S. market, right? U.S. market, and then they did uh, small cap, large cap, and then long-term bonds, right? Did we talk about last time? What was the average? I didn't talk about that. Average Sharpe ratio, like historical. Now, apart from, these numbers, these are small, but you can tell. Uh, Overall, look at this, 9.21. Oops. The entire world equity return, over these like 85 years was, this is nominal, 9.21%, 9.21. But real, that's excess return. Real return, total rate, real return, that was nominal. Real return wasn't that far behind. It was like 8.03%, right? Only like 1% inflation, 1.2. And look at the U.S. Small stocks, small cap, entire period 11 point, and of course these are all annualized, 11.8, and then 8.54. Large cap, pretty much like world equity returns, 9.82, and then real return was 8.43. Not that far, right? Pretty much. So, and then I'm just skipping the bond, but bond obviously they show pretty much the same result, right? Some periods would have, some periods might um, have slight variations, but the trends are pretty much the same. The world, the more and more as towards the late 20th century, and from mid to 20th century, world economy is pretty much integrated. Even during the Great Depression, 1926. Think about it. 1926. That's the Great Depression period. And it's not only the U.S. The entire world economy was also in Great Depression, right? Especially Europe. Germany was in very dire, depression after losing World War One. And look at during that period, 8.31 nominally, and I can't even barely read it. 6 point something. But just a few, uh, sample data. Uh, the point is, the trend is pretty much the same. And then look at the risk premium, excess returns, 7.22, global world stocks. U.S. small equity, 13.91, large cap, 8%. So U.S. did better than world average. Of course, when center of the uh, financial world has since World War One, post World War One era, the center of the global finance moved to New York from London. So with all the money in the world, parking themselves in Wall Street, and U.S. was the only country that wasn't scathed, that remained unscathed by two great wars, right? And with industrial production and the labor and uh, capital combined, and natural resources fast. And U.S. economy has been leading the world, since post World War One. So what would you expect with all the money in the world, parking themselves in the Wall Street? Small cap or large cap or treasury whatsoever, right? U.S. Should be leading, but in terms of bond, excess return on the bond, U.S. wasn't U.S. wasn't the leader. Actually, world did slightly better, 2.09 in terms of excess return, right? And of course, that's quite understandable. I mean, if the stock market is doing well, bond return won't be doing well, vice versa, right? Because the money moves from, if the stock market is not doing well, the money finds haven or shelter and bond, right, for safety, right? Anyway, so we can't go through every we can't go through everything on the table. So, but let's take a look at the summary statistics, right? So this is the world equity portfolio, right? Mean looks like something like 8 point something, right? I mean, that's not what's important, right? What's important, because the mean values, you can read it from the table. What's important is this is U.S. large cap, small cap. Look at the variance of the small cap, right? This is almost 90%. Of course, the mean is just like 11. Mean is found on a very high, what was the mean for U.S. Yeah, small cap 11.980, something like that. Even real return was 8.54, right? Large cap 9.9, 9.62 for nominal return, and 6.43. Is it 8 or 6? But small cap. Look at this. Very wide variance. I mean, even one standard deviation would be one standard deviation would be at least something like one standard deviation here. I mean, just roughly one standard deviation is almost even. So what does that mean? Small cap, very volatile. And of course, volatility means, there's also a good chance of, making, higher return, very high return, extraordinarily. And look at the variance of the bond. This is the world, right? Of course, bond would have very low variance, right? Bond returns would have very low variance. And this is, T-bills, I'm sorry, I thought that was world. T-bills, and this is, long-term treasury, right? Treasury bond. And world, bond, look at the, and look at the correlation between large stocks and long-term bonds and T-bills, right? T-bills are, relatively, very steady, right? That means, less volatility. It's clear. T-bills are, very small. Very small volatility, and that was already, seen here, right? T-bills are. And the large stocks and long-term bonds have pretty much, they move in, like tandem, right? Since at least, since 1970s, look at prior to 1960s, they're not closely tracking each other, right? And at that, but since 1970s, look at the volatility of the long-term bonds, and almost, tracking each other. And this is the reason. Remember when we did the stocks, remember to forecast the aggregate stock market, right? 10-year Treasury note, right? 10-year Treasury note was the we exploited the correlation between close correlation between 10-year Treasury and the aggregate stock market. Remember that? And so this is the sort of like summary, right? So the real geometric average, right? Real return, real cost of equity for large corporations, right? Large cap has been about 6%. Excess returns need not be adjusted for, we found real returns from nominal returns by adjusting for inflation, right? As for excess returns, don't we need to adjust it for? No, we don't need. Why? Because they are returns over and above nominal risk-free nominal risk-free rate. So we don't. It's not necessary. I mean, magnitude of that risk premium is important, right? The magnitude is important. Magnitude of the difference is what's our concern, not whether it is adjusted for inflation or not. Average real rate on small stocks has been on consistent decline, steadily approaching that of large stocks. That was the trend, and this this is long time, large stocks, but it's you check it out from the book because the way it is there, it's hard to read. Right? These fine prints, my eyes are. I mean, it's hard to. But as you. But let's take a look. Small cap. Each period, right? Small stocks. They did much better. 11.32 in the earlier. Early. The first 30 years, right? And then 13, much better. But now, then, from 1985, look at it's like 8.99 or 9.99, and this is, large cap, 9.71, right? They are pretty much, close. They are pretty close, 8 point, real return on the small cap, 8.9. So from like the last 30 years, in the late 20th century and early 21st century, small cap return has pretty much, closed the gap with the large cap returns, meaning, don't find that much, opportunity in the small cap. Why would that be the case? Why is that? It's pretty much, it's pretty much because average size of small firms has grown tremendously, right? What used to be a small company back in 1980, right? Like Apple was a very small startup. Microsoft was a small startup. They are now industry giants, right? And it used to be, in 1980s, they were these are, new high-tech companies, and they all were listed in and traded on NASDAQ. They are still on NASDAQ, right? So, and NASDAQ used to be index for and the market for exchange, right? For small high techs, but it's no longer for small high techs. So their size has reached the level where there exists little remaining small firm premium, right? There exists little remaining small firm premium, albeit still far smaller than larger firms, right? A lot of them are still smaller than larger firms. And higher than historical average returns recently by long-term bonds are due largely to capital gains earned as interest rate plunged in 2009, 2010, Great Recession, right? I mean, after the financial crisis, right? Low interest rates, right? Helped, long-term bonds, right? Higher valuation, right? Capital gains. And large differences in the average returns across historical periods. yeah, reflect tremendous volatility of annual returns. None of the differences between sub-periods. However, none of the differences between sub-period averages and the entire 85-year average exceeds one standard deviation for stocks and 1.8 standard deviation for bonds. 1.8 standard deviation is already very, uh, um, think about it. Within two standard deviations, that's like 96% of the beta, right? But for bond, uh, the variance is relatively very small for bonds. So obviously, 1.8 standard deviation is, in terms of standard deviation, it's a large standard deviation, but in terms of numbers, won't be that wide range of variance, right? So differences in subperiods are nothing but statistical noise. In other words, because they are not significant in terms of standard deviation. But are these portfolios normally distributed? If you check the if you check the skew and kurtosis, right, you can find they are highly sensitive to extreme outliers, reliable only in very large samples, right? They so these statistics, right, skew and kurtosis vary considerably across subperiods. And through and through, you can find excessive positive kurtosis. Positive kurtosis, polar, distribution is taller than normal. It's leptokurtic rather than mesokurtic. And negative skew. Negative skew means distribution is more to the right, right? So extreme gains and losses are significantly more likely than would be predicted by normal distribution. So we need, value at risk with likewise normal distribution to augment the standard deviation. Value at risk is in order, right? Now, important thing is the Sharpe ratio of the stock portfolio. Sharpe ratio has been, around, somewhere between 0.37 to 0.39 for overall history, right? And then 0.34 through 0.46 across all sub periods, or 30-year, sub period, right? So return risk trade-off in stocks on an annual basis is about 0.4% risk premium for each increment of 1% to standard deviation. In other words, 0.39 means what? 0.4% risk premium, right? For 1% increment of standard deviation. I told you, when we price of risk, price of risk is generally it comes out as a number greater than 1. But usually, Sharpe ratio comes out as a number between 0 and 1. Why? It's the same risk premium divided by, one thing is divided by variance, and the other thing is, Sharpe ratio is divided by standard deviation. And standard deviation is a square root of, variance. So think about it. Variance is the square term. I told you, when you square or multiply or square, number between 0 and 1, it gets smaller. So when you divide by variance, you get a, as a result, you get a bigger number than when you divide it by um, standard deviation, right? Makes sense? This has been, basically, like last 85 years, 1926 through 2010 uh, trend, or I wouldn't call it trend, it looks like, but like a mean, right? Average, right? Um, and what about international diversification? Well, because we like, world, equity and world bond, and did we find significant difference between, world stock performance and U.S. stock performance? Yeah, not very much, Uh, International diversification doesn't deliver impressive improvement for passive investors. If you're a passive investor, right? Because um, the global economy, especially in the late 20th, mid to late 20th century, and since then, our global economy is more integrated. Something bad happens in the U.S. economy, the same thing. There's it spreads throughout the world. So it's quite obvious why that is the case. However, it holds large potential for active investors. Still, there's room for room to exploit if you're active, investor, and a lot of still international diversification is still practiced by wealth management firms, still. You have to do, security, real good, very diligent, security research. Again, it's all weighted average, In the global economy, what is the, percentage of the U.S., GDP? Let's say it's 25%. And what is the, GDP of EU? What is the proportion of, EU? Let's say another, 20%. Japan, what's China? I mean, what's Australia? What's South Korea? What's UK? I mean, in that proportion, they actually allocate the funds as capital by that proportion, right? Into a globally diversified portfolio, right? That's what it's meant by globalized, globally diversified portfolio, really, by GDP proportion, right? Oh well, we're out of time. Actually, we haven't even covered this part. We have already exceeded like 10 minutes. It's supposed to be like 30-minute video, so we're out of time. So we'll have to. We'll have to continue in the next next session. Thank you for watching. I'll see you guys in the next video. Start recording.